Good evening, everyone. Welcome to this TradeStation webinar. Who's ready to learn some options? I'm sure everyone here is. I know that I'm excited because Brandon is joining us and he brings a ton of experience in trading options. But before we get to him, let's go through some introductions and some disclosures. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. For me, it's always a pleasure to host these webinars. We get an opportunity to get to know each other and learn a lot from industry experts like Brandon Wendell. We're going to do an introduction for him in just a moment. Before doing so, let's go through some disclosures. Just keep in mind that every symbol and idea that we talk about in this presentation is for educational purposes only, that these are not recommendations of TradeStation. Also, that past historical performance is no indication of future results. We all need to be aware of that. And also that Brandon Wendell is not affiliated with TradeStation, and his ideas are his own, and they don't represent the views of TradeStation. Options trading is risky, and we all need to be aware of that. We have all the appropriate links right there in this disclosure slide. You can visit www.tradestation.com/important-information for additional details. All right. One thing that I wanted to point out also, let me just go here to the next slide so you can start reading on Brandon's bio. But before I pass the microphone over to him, I wanted to highlight some of the work that we've been doing recently in the options field. If everybody goes to TradeStation.com and hover over Learn, you're going to find the Options Education Center. In fact, let me go ahead and share that link with everyone here, just in case you want to jump right to that link. There it is. We're doing a lot of articles and a lot of educational content on options strategies, specifically multi-leg option strategies. So I want everyone to explore some of the articles that have been posted already. We have a carousel here that you can cycle through, and also past webinars that we've done in the past. So make sure that you visit that link, explore all the different content that we have there, and I'm sure you'll find something helpful in your options trading. All right. Well, let me go ahead and pass the microphone over to Brandon. I know that everyone is here for that purpose. So Brandon, the floor is all yours. Thank you for joining us today.
All right. Thank you, Jesus. Hopefully everybody can hear me okay and see me. I will, let's see, go ahead and share my screen. Oh, actually, you have to turn yours off and then I can share mine, I guess.
Yeah, let me go ahead and stop mine. Hold on. There we go.
There we go. And let's see, screen one, share, and we're good, I believe. Okay, let me see the chat too. There we go. Perfect. Okay. I sound okay? Perfect. Probably look better with the camera off, but that's all right. Oh, congratulations. Working on level 1 for CMT. Awesome. So what should you expect from this today? What are we getting out of this webinar? Well, hopefully some good education, maybe a little bit of entertainment. I don't know. So good evening, Stephen. We're going to talk about bull put spreads. That's the focus of this. And I hope that you grasp the fundamentals of that strategy and start to put it to work for you in your own personal trading. I'll be using it on demonstrating how you can use it on TradeStation, as well as there's a workspace that, believe it or not, is actually available for download for you to use. It was on that education center, the Options Education Center that Jesus mentioned and showed to you. I might dive into it myself in a little bit, but yeah, you can kind of follow along and put to practice some of the stuff I'm going to talk about today. So again, how to actually apply the bull put spread into your trading strategies. And well, I kind of already said most of this stuff. So TradeStation tools, but I also didn't say, and we'll get to how to actually place those orders in OptionStation Pro. And there's some really cool things you can do with the OS Pro. If you get a chance, if you go back, Jesus did a really good video on the activation rules. And again, that's going to be available in that Options Education Center. I'm going to demonstrate some of the power that has, because you can actually put in stop losses and take profit targets using the activation rule on option strategies, which is pretty cool. So it's kind of neat. So we're going to talk about what is a bull put spread. It is a multi-leg credit spread. So multi-leg meaning more than one option. They're going to be doing two. They're both going to be puts. Bull, obviously, we're looking for prices to be moving up on the underlying security that we're trading. And credit spread, meaning we are going to be collecting credit or premium to make a profit. So basically, we're going to sell a put, which is collecting premium, as I said. Then we're going to go ahead simultaneously buy a lower strike put on the same security and same expiration, all the same, except for the strike price. And we also have to pay a premium. Well, combine those two together, basically, that long put will reduce or limit the risk of the position, but at the same time, it also reduces profit. So yeah, Ralph, I met Ralph a while ago. I haven't talked to him in years. Anyway, so yeah, that's the bull put spread. It's just selling a put and then buying a lower strike put, and you're collecting premium, which will be your profit. So, based on the underlying price movement, the way it works, if you sell a put, the premium collected by selling the put is the maximum profit that you could possibly receive. And your potential loss, unfortunately, is a little bit big because it is the strike price down to zero when you sell the put. Basically, when you sell a put, you are obligating yourself to possibly buy stock from someone if they decide to put it to you, hence the name a put. Well, when we buy a put, basically your loss is limited to whatever you pay for the option. Whenever you buy options or do a debit, you can't lose more than what you paid for the option, period. And the profit is actually quite large. You'll notice, when we sell a put, we have large risk and limited reward. When you buy the put, you have large reward, limited risk. So we're going to try to combine some of those features to get what we want out of this position. Let's see if the animations work. Oh, no, I did this one instead. So again, we're going to sell a put, collect premium. We're buying a lower strike put, which should have a lower premium attached because it's further out of the money, which means it's less likely to be exercised or used. So you pay less for it. And overall, you come out with a net premium or a credit that will be your profit. So the maximum potential profit you possibly could have in this strategy is just the premium you receive when you open the position. So I guess you could say you're starting off at the top level and it can only get worse from there. But hopefully it ends at the top level again. Well, we need to know everything about our positions before we get in. We should always know these things. We want to know how much we could potentially make and how much we could potentially lose. Well, the bull put spread is a limited risk strategy. So the risk is limited to the difference between the two strike prices minus the premium you collected. Okay. And there's one more thing we need to know, and that is our break-even price. So in this case, the strike that we sold, the put that we sold, minus the premium is our break-even price. So as long as price of the underlying security stays above that break-even, you make a profit. It may not be the maximum, it could be somewhere in between, but as soon as price goes below that break-even price, you start losing. And again, you can only lose up to a certain amount. That certain amount would be the difference in the strikes minus the premium you took in. So yeah, it's kind of neat. We know exactly what the best case scenario is, the worst case scenario, and where everything changes. That's the break even. Oh, and one more thing, this is pretty important as well. Whenever you sell an option, you basically take on what's called assignment risk. Moved on me, didn't mean to. What that means is you could be assigned and required to fulfill your contract obligation. Remember, you sold a put. Somebody might decide they want to put stock to you, so you are obligated to buy it up until the expiration, or if you end up closing out that position. So either you buy back your obligation on the short put, or the option expires, then you no longer have that assignment risk. There is some way of kind of avoiding some of that. If you're not familiar, there are two different types of options. We have what are called American style options, and those options can be exercised whenever they want. So as soon as you purchase one of those options, if you buy the option, you can exercise it right away. As soon as you sell one of those options, you could be assigned right away. The alternative is what they call European style options. And those are predominantly index options. So I do a lot of trading on the SPX options, the S&P 500 index. There's options on that index. You can't actually trade the index. You can't call it away or put it to somebody. All those options are cash settled, but they're European style, meaning you cannot exercise early. You can only exercise at the expiration of that contract. So if you're worried about that early exercise or early assignment to reduce that happening, or really pretty much eliminate it, you would only want to trade European style options. And again, those are predominantly on the indexes, not on stocks. So you could trade sectors, ETFs, options on stocks. Obviously, there's a lot of different types of options out there, even options on futures. So, and this strategy, by the way, applies to any of those. Okay, it's a strategy that you can trade wherever you want or on whatever you want for the most part. So why the heck would we even want to deal with this? Why trade the bull put spread? Well, they have higher probabilities to profit. A lot of people who are looking to profit as a security is moving up, they'll either buy the stock if it's a stock or an ETF, or they'll buy a call. Well, the problem with buying the call is that it can be costly, and you only make money if prices go up, and they have to go up far enough that you cover that cost before the expiration. Right now, the prices are here at 169. Notice we'll focus on the blue line right there. That's at expiration. If prices were to go up, obviously I make a profit. This is a bullish strategy. If prices were to stay where they are, I'd make the profit. And if prices dropped a little bit, as long as they don't go below that 165, still make a profit. So there are 3 different ways of potentially profiting versus buying the call or even buying a stock. Yeah, granted, if you buy the stock, it does cost a lot more, but you also get dividends. Okay. This is not pre-recorded. This is live. Anyway. So I also said it's limited risk. And the reason why it's limited risk is that you cannot lose potentially more than the difference between the strikes minus the premium you collected. And the question came up, or not, I guess it was a statement. No, I guess it was a question. Yes, if the prices dropped below both strikes, so let's say we had this catastrophic collapse in Apple down to $150, right? And I do get assigned on those puts at 165. Yes, you can exercise the 160 put. Basically, you would be buying stock at 165, selling it at 160. You still lose the difference between the two. Minus, remember, you took in premium. So that premium goes against that loss. So you are limited in risk to the difference between the 2 strikes, again, minus the premium you collect. So what scenario could you lose money? Whenever price goes below that break-even point, whatever that break-even point is, which is simply the strike that you sold. So in my case, I sold the 165 minus the premium we collected. Well, we took in $2.22 in credit. So 165 minus 222 is the break even, which is right around 162.75 or so, a little higher. That's it. So the margin requirement, by the way, could be much, much lower by doing the spread versus simply buying a call. If you were to compare the two, because one of the things you have to do when it comes to buying options is make sure you're avoiding a lot of time decay. And that time decay is a problem. A lot of people go for the cheap option thinking, well, I won't spend as much. I'll buy an option that expires sooner. The problem is that time eats away at their profits. Options are like ice cubes. You take an ice cube out of a freezer and it starts melting immediately. Okay. If you have a small sliver of ice, an option that has very little time left, it will melt much faster than a large chunk of ice. Okay. So the same thing happens with options. If you have an option with a lot of time left, it will melt or decay slower than an option with a little bit of time left. So when you're buying a call option to make money on a move to the upside, you're going to want to buy enough time that you're not going to be as affected by that time decay. And that's a mistake a lot of newer traders or even some senior traders make from time to time, not buying enough time. The trade has to work out. You have to give yourself that opportunity for it to work out. So we get a lower cost by using the spread versus buying a call that has further time because that costs more. The other nice thing, the last one there, reduced need of accuracy in price forecast. I already said that basically we can make profits if prices go up, sideways, or even down a little bit. So we don't have to be as accurate in where prices are going to go or how soon they're going to go, because we'll profit as long as prices stay above a certain level. So it gives you a little more freedom when it comes to your trading, perhaps. So we need to know not just what the advantages are, but also the risks. We got to be fair and balanced here, because there are risks. You could lose money. So the one disadvantage that the bull put spread has versus other strategies, you might have noticed the risk is larger than the reward typically. And a lot of people are looking at that like, wait a minute, I thought you're supposed to have smaller risk versus reward. Well, again, if I go to, I closed out the other one, unfortunately. So I'll do this. Let's say we do a bull put spread here on 50-60 on the SPX and 50-55. There's a bull put spread. You can see the max profit, 280, max loss, 220. It's almost 1-to-1, right? So a lot of times, though, when you do put these on, let's go to Tesla. It could bounce. I know it just got pushed around with the earnings there. And let me clear this. There we go. So again, if I go out to Tesla, let's say we do 29 days, it was May 24, and we're looking at a bull put spread. We're at 160 right now. So I'll say we're going to sell 155 and buy the 150s. There you go. You see the max profit is only $158 while the max loss is $342. So why the heck would I want to do something like this if I have a lot more risk than I have profit? It's about probability. Again, we have more probability that this should work out compared to a strategy where you need a big move before you even break even by buying an option. So that's one advantage. The other one is you could put a stop loss. That's the maximum loss. Doesn't mean that that's what we have to endure. Anyway, again, the early assignment is a risk. Anytime you short an option, you have the risk of an early assignment, period. You could also get a large price drop. This profits if prices go up, but if for some reason the price just collapses, well, you could lose money, obviously, but it is limited risk. You can reach the maximum risk, but it can't go beyond that, which is kind of nice. So let's talk about some of those Greeks and how they affect. I kind of went a little bit into that already, and I'll be answering a lot of those questions. Don't worry. Let's try to hold off on some of the questions till the end, or I'll scroll back and look at some of those, but I need to go through this to make sure, and I'll cover quite a few of those, excuse me. So time decay, I kind of mentioned a little bit about it, but basically time decay is something we're actually playing when it comes to the bull put spread. So the theta of options measures the time decay, if you're not familiar with that. T for time, theta. So the bull put spread has a positive theta, meaning it profits from time decay. That's an advantage. But again, we are looking at positive theta with these spreads, and we benefit from time decay. So time decay lowers the premium. It melts the ice cube and makes it cheaper if we would have to buy it back before expiration. Most of the time when we're doing these spreads, our goal is to allow the options to expire worthless or out of the money, if you will. And that way, we open the spread, we don't actually have to close it. Anyway, time decay is greatest within 30 days or less. I kind of showed you that already on the options chain. And volatility is another big thing. So we want theta to decay and erode those options. So that way, and again, in the last 30 days, it erodes the fastest. Actually, before I move to volatility again. So the next one we're going to talk about is volatility effect and how volatility affects or influences the bull put spread. So volatility is measured by something called vega, which is not actually a Greek letter, but they throw it in there. Sometimes you'll see kappa as a substitute, which is a Greek letter. So anyway, vega, V for volatility, that measures the volatility effect on premiums. And we're going to have negative vega, meaning we want the volatility to drop. So when we enter into positions, we want volatility to be pretty high and then dropping. So the bull put spread potentially profits, as I said, from the drop in volatility. And you can see, we can actually play with that and see what will happen with pricing. So I have an example here where volatility is not adjusted on the price slice. And then after entry, if the volatility changed, if nothing else, the value, you can see the price didn't change, 167.82, value negative 149, zero volatility. 5% of volatility dropping went from what, 142 value to 130. We didn't even change the price. Volatility by itself is probably the single greatest influence on option pricing in the premiums. And if you don't pay attention to it, you got to be careful because it could really bite you. That's something you want to pay attention to. So, here we actually did another 5% and the value jumped downwards again. It shows a negative number because you're thinking, oh no, you're losing more. No. That's the value of the option. And to buy it back initially is at 150 bucks with zero volatility change. The volatility drops by 10%. And now it would only cost you $103 to buy it back. So that would be a profit, obviously, because if you sold it for about 150, buy it back at 103, you keep the difference. So we typically want to enter when volatility is very high. So we look to see where is implied volatility, and volatility and even price is elastic. It usually will stretch away from the average and snap back, stretch away, snap back. So if we can find high volatility situations on securities, they may be an opportunity for a bull put spread. So we'll take a look at that. And I did another 5%, and you can see it dropped down to 65 bucks. Went from 150, lost about $90 of value with just 15% volatility change, which can happen very, very quickly. Okay. Yeah, there's actually a couple different places to see implied volatility. One, you'll notice on the option chain, implied volatility is shown for each series or week of the options. So there's your implied volatility. Now, that's just a number on its own. You don't know whether that's high or low unless you look at a chart and kind of track it based on where's implied volatility now compared to where it's been in the past, or even compare it to historic volatility. Historic volatility is really just a chart. Historic or statistical volatility is how much prices moved in the past, which you would see on a chart, basically. So we're going to talk more about that. The plus and minus you see here is how far prices are likely to go up and down based on that volatility from where they are right now. So if you're not familiar with that on TradeStation, currently 29 days left. By May 24th, we currently have 48% volatility on Tesla, and we should see close to an $18 rise or fall from 160 bucks. That's what that's suggesting right there. Now, it's not guaranteed, of course, but that's what it's suggesting. It's kind of neat. Anyway, so when we want to use this, we're going to start taking a look at, what are we going to do with this and how we're going to put one together. We're going to search. We'll take a look. I think I have a lot of time left. I don't even have a clock. Anyway, we want to look for relatively high volatility, as I said, and we have tools for that in the charts. We actually can use things like radar screen and hot lists that are built right into TradeStation to help you do it. So again, it's not an exact number when it comes to volatility. You can't say, oh, if volatility is over 65%, we want to go ahead and sell. No, that could be a security that typically has 140% volatility. So you got to look and compare to what it's doing now compared to what it's been doing in the past. And as I mentioned, there's indicators like implied volatility, all options, or the ratio of implied versus historical volatility. And we expect the volatility to drop. If we're looking at high volatility, I said it's elastic. It normally will come back towards the average. Now, it could keep going, so there's a risk, obviously, but you can't get reward without risk. I hope you realize that. They go hand in hand. If you want big rewards, you got to take big risks. If you take moderate risk, you get moderate rewards. So that's pretty much the way it works in the markets. So we're going to look for high volatility, relatively speaking, to where it's been, and we're expecting the volatility to drop. So if the current implied volatility is way above the average, and you look back and you see every time it's been that far above the average, it's gone back down, there's a high probability it'll do it again. That's all. Just look for patterns. Keep it simple. So also a high implied volatility versus historic ratio might drop, and that would help the bull put spread. Let's see. Oh, okay. expecting the price to move sideways or slightly upward. It is a bull put spread, so we are expecting possibly prices to move up, but we don't really need to move that or have them move up too far too fast. So it could be a channeling stock that's just kind of caught sideways, maybe near the bottom of the channel, and we're expecting it to rise a little bit. But the maximum profit is going to be realized if your options expire out of the money, basically. So this is neutral to moderately bullish for strategy. And you want high implied volatility that's likely to revert back down. So you could do this, like I said, on a sector or an individual stock, whatever you'd like. So the short put option, we want that to expire worthless. It should be below support or a channel. Like I was just saying, at the bottom of a channel or not underneath the support level. So right here, finding high volatility, kind of showed you the tool already. There's the other one, implied volatility versus historic volatility. And I was looking at Apple in that case. It's so much easier when you're looking back. Obviously, it's harder when you're looking at the hard right edge. But again, if I go back to my big chart, we'll get to another workspace in a moment, and bring in that other tool, studies, and I'll add in the indicator. Yeah, why is it not working? There we go. And implied volatility versus historic volatility ratio. Let's see, we'll do a different color for this one. Maybe like that light blue. And the percentages, make those a little bit brighter as well. I'll do pink. Why not? Went to a match this past weekend. I saw Messi playing in pink. There we go. So there's our second indicator, which again is simply showing us the ratio of implied volatility versus historic. And they even have kind of an overbought, oversold line, if you will, that we could potentially use to identify if the implied volatility is well above the average and we are very high compared to our historic volatility. There's a high probability volatility will drop. Again, it's not guaranteed, but it's a higher probability. So if we take Tesla and just go back in time, you've never actually had to exercise an option. If someone exercised the put, how would you exercise your option? I believe you might have to contact the trade desk. I'm not part of TradeStation to know that kind of stuff. But I believe if you want to exercise, you may have to contact the trade desk for that. I don't know if there's something on the platform for it. Anyway, what we got going on here is I went back in time to, when were we here? 2022. And again, it's real easy to see when volatility was high looking back. The hard part is figuring out on this hard right edge. So obviously, if we had maybe a peak above the alert for implied volatility here, and we're way above the average, there's a high probability that volatility will come down and we should sell that volatility. But again, we also need it to be price moving sideways or possibly up. So this is only one piece of the puzzle. But if we start going, implied volatility on the top went up a little bit compared to the average, but it wasn't really very high on the bottom indicator. So I'm kind of looking for both to be very, very high. We're still not there yet. Okay. Again, we're above the average, but not really very high as far as previous ratios of implied volatility. Now we're getting somewhere. You can see we're above the average, and we have pretty high implied volatility versus historic. Prices are moving somewhat sideways. So at that point, whenever that was in April 2022 or 23, actually, I think, if we expected prices to hold this level of support and continue the channel or even go up, this would be a possible candidate for the bull put spread. Let's do this. I'll put in a vertical line to mark that date that we saw it. And it's off a little bit. Right about there. And the price. Maybe. There we go. Horizontal line. We're looking around 180. Wow, I got my snap mode on, don't I? That's close. There we go. So if we did something like a 180, 175 bull put spread, whatever that premium was at the time, we'd be collecting it. We would sell the 180, buy the 175. Our maximum risk would be the difference between those strikes, which is $5 or 500, because each option is 100 shares, minus whatever premium we took in. So I don't know what it would have been. I couldn't even guess right now, so I'm not going to bother. And what's happening with volatility? It is going down. By the way, this is just before earnings as well, wasn't it? There's the earnings date or the earnings release. But unfortunately, just before earnings were released, the day before, it's kind of hard to see with that number there, isn't it? Let's remove that. You can see prices pretty much went sideways, but the volatility dropped because it was extremely high, and it was very high in the ratio as well. Probably would have made some profit there, but we had to exit before the earnings release because the prices dropped for that. And you still might have made out okay, but just because it went below 175 now, you would have been at max loss at that point. So definitely would have had to get out before the earnings release. That's not really the way I look for those opportunities, by the way. It was just an example I was trying to use for you. So if we want to find high volatility, that's one way of doing it. Look for the high implied volatility versus the average, and high is implied volatility versus historic over that overbought area. So with the two of those together, there's a high probability volatility would drop. And again, if I go back to that example, keep going until I find another example, it may be the next time there are earnings. Oh, look at that. There we are. We're above the average, but then we finally got above the overbought implied volatility, if you will. Right there is where we crossed over. I'll put it here. So again, we're right around 220. So if you did a bull put spread, we're also in a nice bullish trend. I would make sure we're not near any kind of resistance, of course. And volatility is likely to come down. Unfortunately, it went up a little bit first before it came down. But it did come down. And not only did it come down, but the prices stayed up from where you would have entered. That probably would have been a very nice trade. So depending on when they expired, should have expired obviously above 220, which we would have sold maybe 220 and 215. Yes, this is recorded and will be available for rewatching. So if we want to find these a little bit better, again, we've got tools that we could use, and it's stupid not to use those tools because they're available. So using the radar screen, we can actually use a filter on the radar screen to figure out, okay, what's a good candidate for us? Well, we got options that are liquid. So we want to have open interest on the options above 10,000. You don't want to be the only person trading the option. If you are, the spread or the difference between bid and ask will probably be too large. So you want liquid options, at least 10,000 on open interest. That means somebody else is trading it and it's a good opportunity. We want MACD to be greater than MACD average. You can use different different indicators too. You don't necessarily have to use these, but if the MACD is above the average, you're in a bullish trend. These are applied to a daily chart on the radar screen in the workspace. The RSI is above 40. That's actually a personal one that I like to use. I use different numbers for overbought, oversold on RSI. I use 40 and 60, not 70, 30. And I use it more as a momentum indicator. So RSI remaining above 40, even on pullbacks, means that that security is in a bullish trend. Now, it may not be in a strong bullish trend, but it's bullish. Implied volatility is higher than the average. Kind of cuts it off here, but you'll see it if you go into, oh, that was just there. Again, going back to the workspace for bull put spreads. Once it gets there, there it is. You can actually go in, and the indicators are right here as well. And of course, if you have questions about the indicators, you can always go to the help for the indicators as well. But you see, we have implied volatility is greater than implied volatility average. I think it is. Yeah, there it is, average. And finally, percent change, that's over the last 20 days. You can adjust that as well on the indicator. You just simply go in, percent change, studies, and just right click there and edit. So right now, this is set up to show securities that are up 5% for the last 20 days or from the last 20 days. So going back 20 days, that candle to where we are now, the price is up at least 5%. And you can adjust that and play with that as well. But these are finding securities right now. This is just on the S&P 500. And there are currently, well, was it 16 stocks that are listed that meet that criteria. They have liquid options. They are bullish on the daily and probably even the weekly chart. And they're up over 5%. So if I click on one of these, it's set up with the link to the chart. Oh, this one gapped up quite a bit, so we probably don't want to play that. Go to ConAgra. And again, I can look, hang on. This is moving really slow. I don't know why. There we go. I wanted to shrink the candles down to see the overall shape a little better. And I could search through those and even put in the indicators for volatility or put it onto the other chart as well. As a matter of fact, let's do this. Oops, did the wrong thing. Oh, that is set for green. Okay. So again, if I go to bull put spread, change this global symbol link, now it'll change on my other chart as well with the volatility there. So again, CVX, it's already up a little bit. Would have been good to catch it down here at about 155. And maybe we're looking at too bullish perhaps. So what I could do is change this and just say, okay, we should be positive. So we have bullish stocks, but not as bullish as 5% up from the last 20 days. And again, start looking through those. Now, if I really want to find high volatility, here's the other thing I could do. The next page, you notice there's actually multiple pages here. We have a hot list that was added to the radar screen. And for some reason, what the heck happened here? It deleted my scan. Well, I just have to put it up again. Fortunately, I was smart enough to take a screen capture of what I needed on that page, so I can just copy it. But it's not a big deal. So I just go open interest, all options, greater than 10,000. And I want to make sure it's bullish, so I'm going to use the MACD is greater than the MACD average. So we have a crossover that's going up. There we are. And we're narrowing it down a little bit, aren't we? RSI is greater than 40. Narrowed it down even more. And we want to make sure the implied volatility is high. That may actually cut them all out because I'm noticing none of them are above. Oh, I'm sorry, no, these are above the average. Really cheap stocks though. So that one might work. ANVS, let's take a look. Bullish stock volatility is at 350% versus 309 for the average. So very, very high. And unfortunately, it's already run up quite a bit. So I may not want to trade that one. Again, these are the highest implied volatility. There are other hot lists that you can explore and add to. Let's say we want to have implied volatility breakout above the 10-day average. Maybe that narrows it down a little bit better for us. Again, I can start putting in those filters, open interest, greater than 10,000. And again, MACD. And then when I get to the OptionStation Pro and actually place a trade here. So we want the MACD above the average. And it knocked it down quite a bit. Again, we're looking at our last price. These are very inexpensive stocks. I don't really want to trade something that cheap. So let's see what we got here. We'll try to find, instead of implied volatility highest, we could look for, and it actually reversed it a little bit. It's statistical volatility versus implied volatility lowest. The indicator has implied volatility over statistic. And there we go. Once again, just put these in. It's unfortunate I have to keep putting in the filter, but you just redo the filter if you change the list you're looking at. It's not that hard. So again, open interest, greater than 10,000. Can actually be traded the same on web trading. there's definitely more functionality. The options could be traded about the same, but the functionality is definitely greater on the desktop platform than the web version or the mobile. Again, MACD above the average. There we go. And let's see, UUP, that's an ETF. It's trading at 28 bucks. That's moving a bit sideways. Oh, what happened there? Oh, it doesn't have a certain indicator, I guess, on the big chart. Is it missing implied volatility info? No, it's not. Implied volatility has already come down, unfortunately. I would definitely want to play it when it's much higher, usually. But you see, it's already come down a bit. So for this sake of time, I can go ahead and set up, let's see. I had one I was looking at the other day. You see, it takes a little bit of time to find opportunities from time to time, but it's worth it. So let's say we got Devon Energy, DVN, and it looks like we had a little bit of a pullback, but starting to move back up. Not the best candidate. This is not a strategy, or I'm not saying this is something I would actually trade right now. Okay. I'm just trying to find an example to be able to place an opportunity and show you how the functionality of the platform works. It is a little bit higher average volatility than normal. It is above the overbought area there. Okay. But like I said, I'm not saying, hey, go out and trade this. No, because it's not quite where I want it to be, which would be a support level for a bullish trend. But let's say we have support. It's not, but let's say we have support right around that $51 area. I would go out to my OptionStation Pro, bring up the security, DVN. There we go. And I know that the support is right around that $51, $50, depending on which strikes we have available. Excuse me. Now I got to figure out how much time do I want? Well, if we go out further, again, you look at that theta, it's going to be smaller. If you go to the 30 days or less, the theta starts getting a little bit greater. So typically I'm going to be looking at smaller time frames, and it's a personal preference. You got to figure out what works best for you, what gives you the best opportunity. So right here, we've got 51. That's good. We do have the 51 options, 22 days left till expiration. So we could sell that. And I hold down the control key and I could buy, let's say we do a little bit more. I'm going to get greedy, not too much. But right there, I'm going to do the 49.5 put. So I'm creating a 51, 49.5 spread. It's an odd number, but that's the way this is set up right now. Right now, I'm looking at a maximum profit because I'm bringing in, actually, I should probably, well, I'll use the mid, that's fine. $46. That's my max profit, the premium you take in right away. Max loss is $104. Again, that's the difference between the two strikes, 51 minus 49.5, minus the premium we're taking in, right? So the difference between the two is $1.50, but we're taking in 46 cents of premium. That gives us $1.04 of risk, or $104. That's how that's calculated. Pretty simple. So if we want to put this on, we can actually figure out, based on the option and time, where we make money, where we lose money, what our break even is, all that stuff right here. Pretty simple. We already know our maximum loss, maximum reward. At expiration, basically we break even as long as prices, again, we put this to, oh no, plot one, that's the, oh no, May 17th is the expiration. There we go. So there's the expiration date, May 17th. And if I want to know what break even is, I should just move one of these to where it intersects right about there with 0 for the profit or loss. And it's close, basically about 50. There it is, $50.54 is break even at expiration. Now, before that, it's going to be different because there's time value and other things that are affecting it. Again, we know our break even at expiration. We need prices to be above $50.54. If they are above $51, which is our strike, we get to keep our full profit of $46. That's it. And the max loss is what you have to put in for your margin. So basically, let me see here, calculator. we have a profit potential of 46 bucks. We're using $104 to make it. That's a 44% rate of return. That's pretty good. And the probability of that happening is pretty high. Now, I know as a shortcut, a lot of people use delta. That's not exactly right, but delta is a measurement. It does a couple different things. It tells you how much you're going to make or lose for every $1 move in the underlying. It's a hedge ratio, which I'm not going to get into right now. And number three, a lot of people use it as a shortcut for figuring what is the probability of finishing in the money. So this is saying there's only a 13% chance of this spread finishing in the money. Okay, that means that we have an 87% chance of it finishing out of the money and maintaining the full profit. 87% chance to make 44% in less than 30 days. Sounds pretty good to me, doesn't it? Compare that again. The other alternative, if you were bullish on this stock, would be to go back and buy a call. And well, I'll even use the same month. It doesn't matter. We're right now sitting at 52 bucks. You buy the 52 call. There you go. We analyze that. We have a delta of 53. That means we have a 53% chance of it finishing in the money. Now, it doesn't mean it's going to be above what we paid for it, right? We need this to go up to our break-even price at expiration. It's roughly, well, it's what you paid for it, basically. So if you're buying it, it's a 52 strike plus $1.76. That would be 53.76 for your break even. So there's a little over 50% probability of it going up, but it's got to go even further to make a profit. Meanwhile, that spread didn't even have to move and we could profit. And there was an 87% probability of it working. Again, it's not exact. And I believe there's actually, no, that's not it. That's theoretical value. There is right here, standard deviations of out of the money, in the money. You can do some more analysis on the options as well. Now, one more thing I want to mention here. I actually don't have that position open, unfortunately, but I can use a different one. So if I go to my manage, these are all just simulated trades we threw in a while back. And let's see, the trade price was an 85-cent credit. So the maximum profit on that Apple spread, again, it's a bull put spread, was $85. The maximum loss is 415 bucks. Just because that's the maximum doesn't mean you have to take that. A couple things we can do to protect this spread if we want to. First of all, I click close this position. And here it is setting up the order for me, closing the Apple spread. But I'm not going to close it right now. I only want to close it if Apple doesn't go where I want it to. When I'm looking at securities, and I'll use this big chart, Apple. So looking at that bull put spread, again, it was 165, and I'm going to get rid of the indicator for now. Don't need them. That spread will profit at expiration. I didn't see what the expiration date was. I'll have to go back and check. But at expiration, as long as price is above $165, there we are, that profits. What was the expiration? May 10th. So less than a month, a couple of weeks away. As long as prices are above 165, that profits 85 bucks, right? And out of curiosity, it was 85 divided by 415. It's a 20% return. Not bad. Now, what if it starts to go against us? Remember, the maximum loss is $415. What if we don't want to lose that much? What if we don't want to lose more than 50 bucks? Well, first of all, we can go in to our analysis tab. Yeah, because we sold the 165. So let me reverse this. There we are. So there's the bull put spread as it stands. And I can use the price slices to figure out, okay, where would I start losing X amount of dollars, right? As long as this is above 165, this should profit. Do you need a large amount of capital and if you're assigned? No, actually, what happens is you only need whatever the maximum loss is to put on this position. So if you were exercised on the short put, you could exercise the other put. And I can't remember what the cutoff is. I think it's 1 o'clock in the afternoon when you're exercised, you would exercise yours. And basically, again, you would be buying at 165, selling at 160, you don't actually have to bring in the money for the actual shares because you're selling it immediately. And there's like a grace period. But again, talk to your brokerage to see how it works with your brokerage. Okay. So no, the only thing you need in order to be able to create this position is the $415 in your account to cover the margin for that position. That's the maximum loss, period. So anyway, you can figure out, okay, if prices, let's just do it by price, price. So this is the closing order that I was creating. And I'll go to activation rule here and say, you know what? If this breaks through that support level, 165, I'll give it maybe 50 cents. If it moves beyond 50 cents, I want to get out. And we can check to see how much that would be in loss. So 165 to 164.50. Oh, need the price slice for that. There we are. And it shows theoretical loss. I don't know why this seems off. Anyway, what we can do though is in our order. Oh, now it's trade right there. I'm going to change my type of order to a market order and use this little activation rule tool. So I'm going to close that trade if the price of Apple goes less than 165.50. Oh, sorry, 164.50. I almost put in the wrong number there. Always verify. 164.50. Single trade tick. Well, we can also put in double trade tick to make sure we're not taken out of the trade too soon. So by putting in that activation rule, I'm basically putting in a stop loss on my spread. That's pretty cool. I can put it in based on the price movement of the underlying security. And I can figure out approximately, now it won't be exact, but based on the price slices, I can figure out approximately how much I make or lose. So let's go back to my original idea real quick, which was on Devon Energy. Now I won't be able to do the entire thing because I can't put in the trade right this moment. You can only put in the stop once the trade is opened, once the position's open. So we were looking at $51, selling the put, and I was buying the 49.5, and I potentially was going to make 46 bucks, right? So we analyzed that. There we are. And this is based on, well, 0 DTE, but let's go, we have 22 days left. Let's say if it goes against us, in a week, roughly. So the yellow line, which I'm going to put the plot to right now, if it starts going against us, currently our break-even point is actually way up here at about 51.79. So if this starts going down, I stand to make 46 bucks, right? What if I don't want to risk more than a third of what I was making? So roughly about 15.25. I can use this theoretical profit and loss and play with this a little bit to see what price level in 1 week would cost me about 15.25. Now it's not going to be exact, but around $50.90, I would lose roughly 15.25. Okay. Well, once I have the position open, let me do analyze opposite trade. That's the close now, which actually looks like the bear put spread. But if I do trade, I can actually change this to a market order activation rule. And now I forgot the number it was, 50.90. If Devon Energy drops, actually less than or equal to 50.90, and it's going to protect me so I don't get one of those late prints taking me out. I go to the double NBBO, boom. That is a stop order that should get me out. Now, it's not guaranteed because it's a market price, but it should be approximately what I calculated. If I took into account everything, I might want to play with the volatility a little bit as well. But that is a stop loss that should take me out with my loss being only 1/3 of what my potential profit was, not the maximum loss. And it should execute around that area. Oh, one more important thing. Don't put it as a day order. It's got to be GTC. Okay. So that's one of the things that you can do that's pretty powerful here is placing that stop loss. You can even put in a profit target too if you're wanting to get out maybe at a certain point. If you see there's overhead resistance that prices are likely to bounce from, you could actually get out there as well. So both for the loss and the profit, even before the expiration of the contract. The NBBO, basically it means that there are 2 trades that went through at the inside bid and ask on the actual stock. So again, if you're not familiar with those, you go to the help and there's a whole explanation on it for the NBBO and stuff. So anyway, it is past my time. I went over here, but this whole thing will be recorded, or it has been recorded, and it'll be available for you to rewatch as much as you'd like. Again, I invite you to go visit, I think I have it open here, the Options Education Center here for TradeStation. And Jesus put in the link for you there. All those different strategies that we've talked about, especially this one right here, credit spreads for bullish moves. It's right on the homepage. You just click learn more, and you've got a little video that's been put together. You've got articles on it and how to use it. And of course, this video, there it is. It shows register for this webinar now, but the webinar will actually be posted there, the recording, so you'll have access to that in the future. So I apologize if I didn't get to everybody's question, because there were quite a few of those, but hopefully you guys enjoyed this and got something out of it. If you have questions regarding this, keep it to yourself. I don't care. No, kidding. If you have questions, you can contact TradeStation and they'll be more than happy to answer those for you as well. Is there one not for noobs as far as webinars? I mean, we're going to be getting into more advanced strategies as well. Yeah, so we're going to be doing down the road. There's going to be more and more being put out by TradeStation Education Department that will have a bunch more details and different strategies out there for you as well for more advanced levels of trading. So, and then we're, just keep an eye out. There's gonna be a lot more stuff coming up. So I want to thank Jesus for having me here again. I appreciate it. And I guess I'll turn it back over to you. I went to overtime. Sorry.
Totally fine, Brandon. I think the information was great. So thank you for sharing your insights with everyone here. But again, I mean, it was great having all of you here. Thank you for your support of the TradeStation family. And we want to encourage you to go to the Options Education Center and continue learning on options strategies. So thank you everyone for joining us today. Brandon, thank you also for joining us today. And I hope that everyone has a wonderful night, and I'll see you next time. Goodbye, everyone.